Today's video I'll be looking at Alphabet, also known as Google. I'll be analyzing the company and taking a look at the fundamentals. I'll also be talking about when I'm buying the stock. Before I get into valuing the company and setting a price target for when I'm going to buy, I'm going to talk a little bit about the fundamentals of the business. Google is a $1.3 trillion company. With the size of Alphabet, there also comes a huge competitive advantage in it that they almost have a monopoly on this search engine space. They own the two largest search engines in the world, Google and YouTube. So this is 41 analysts, you can see right here, that make these assumptions about the future and calculate these things that you'll see here. So heading right down to valuation here, on Simply Wall Street, we can see that the fair value is laying at $4,500 a share. So 50% undervalued according to analysts. The thing there is with this valuation that they have going here is, first of all, you don't have your margin of safety baked in. You have to have that baked in. And also there is some issues with the discount rate that they use. Essentially the desired return that they want. I'm going to get into that later when we look at the intrinsic value. So this is analysts kind of take on the intrinsic value or the fair value, but we'll look at that later. So already here it looks like a pretty good value that you're getting. Future growth is a huge one for Google because of their size and their ability to grow with, forecasted almost 14% over the next 1 to 3 years at a market cap of $1.5 trillion. That is crazy, guys. It gets harder to grow company at the same rate as it gets bigger, and this company is huge. So really great that they can still keep doing this. Let's look at the financial health, because you look just beautiful. In the short term, their short-term assets cover their long-term liabilities, and also in the long term, the long-term assets cover their long-term liabilities. We can go in here to the financials here on finance here, look at the balance sheet, take a look at the total current assets here. You can see that is $1.88 billion, and the total current liabilities is $64 billion. If we go down here to the bottom, we can see the ordinary shares number went from, in 2018, it went from being this number to being 662,000 shares. So they have bought back a good amount of their shares, and I think my thesis with what they're going to do with the cash flow in the future is they're of course going to still focus on growing the company, but in terms of what they're going to do in the future, how they're going to reward shareholders when the company stagnates in growth or just slows down in growth a bit, I think they're going to keep just buying back shares, giving you a bigger ownership, giving you a bigger percentage of the revenue and profits. So I think that is going to be how they keep shareholders interested in 10-20 years down the road. The last time I looked at Google, the only issue that I had with the business was the valuation. So now I want to use this tool here provided by a researcher called Sven Collin. He's also on YouTube. Go check him out. The way this works is basically you put in the growth that you expect the company to make, and then you put in the terminal multiples that the company is going to be trading at, that you think it's going to be trading at. Of course, that is the market that decides that. But right now you can see, for example, the PE, which is also a multiple, that is around 18 times price to earnings. So that is kind of how we go about it. Let's start with this so I can show you how this works. I've put the EPS, the earnings per share, here into this field right here. And what we're doing here is over the next 10 years, we're basically growing their EPS by a certain number. What I've done here is I've taken the normal case, so basically what we can expect to see, and I've put in for the next 5 years a 15% growth. And the reason that I chose that was because I looked at analysts here, and they apparently expect 17% for the next 5 years of growth. So I still think that sounds like quite a lot, 15 for the next 5 years, but if analysts is saying that, then we gotta believe. But then the growth slows down from the 5th to the 10th year. They do 7% growth every year, and essentially that, you can follow it right here, going up in the EPS, and here we add up all of the EPS, that all of the cash that they have generated, and that turns out to be this number. Now we are going to discount all of these values here by 13%. And that is because, guys, you can get 9 or 10% every single year in an ETF, and that is very risk-free compared to investing in individual stocks, and it's also less work. So essentially, I want to get a little bit more for my money, 3% more than I would get in an ETF for going out, doing my research and investing in individual stocks. So that is the desired return that I want every single year. That's 13% that covers the inflation and gives me a nice return. And the terminal value multiple, is 15, and that's going to be in 10 years. For these growth numbers, that seems fair. So that is basically the price to earnings ratio. We can expect that to be 15, I think, in 10 years for the normal case. So that is the normal case. For the bull case, best case scenario here, I put in 20% growth for the next 5 years, and then that slows down to 13 with the same discount rate and a 20 terminal value multiple, because we have had higher growth. And for the worst case scenario, maybe this is actually a little bit too good to be true here. I think for the worst case, I'm going to have to put 7 in here and then slow that down to 5. And with those low growth rates, we have to have a lower multiple here at 11. So essentially that brings us out to $1,300 per share. And then I put in the probabilities here of the normal case, probably a 60% chance that is happening, and then a 20 for the bull and 20 for the worst case, and we get to a fair value of $2,500 per share if these assumptions come true, and if you want a 13% return every year. So, you know, right now it being at $2,000 a share could be a great opportunity to get in. Personally, I don't have $2,000 to put into this stock alone, so I'm going to wait for the stock split that is going to happen in July. And if the price stays at these levels, it's going to be $100 a share, and that is great for me. I'm definitely picking up some shares if it stays at this and even moves lower at $100 a share at that point. So I hope you enjoyed this video. That said, I hope you just have a great rest of your day. Peace out.